Good day, everyone. Thank you for joining us once again here at Seaford & Brew for our economic briefing. I am Jamie Sumner, Chief Analyst, and for this week's briefing, we want to review over a couple of the releases that have come out over the past couple of weeks, and then look at the 10-year, 2-year spread, and finish up with deposit rates. So overall, when we look at the second quarter GDPNow, we can see we're at a robust 4.7%. This GDPNow, if you recall, is put out by the Atlanta Fed, and it's kind of a projection of where they see the quarter's GDP coming in. So for a second quarter, it's estimating at 4.7%. We're still a ways away from the actual release date, and as we come closer to that release date, we should be getting more and more reliable information. So right now, it's at 4.7%. It typically does not stay up in this range for as long as it has, but because of the positive economic information that has been coming out, we're continuing to see this at this high rate. So it will be interesting as we progress throughout the rest of this quarter and the releases that follow to see if this is sustained. One of the reasons why we see this high GDP now rate is because retail sales is pretty strong when we look at it for May, coming in at 0.8% with month-over-month growth. That's more than double the consensus growth, which was at a 0.4. So we have this strong retail sales overall, and then with the ex-auto coming in at 0.9, continue to see, even when you take out those autos, a very strong retail sector. That's a positive because if you recall, in the first quarter, that retail sector kind of waned a little bit. Moving from retails into inventories, we can see overall inventories grew by 0.3% during this time period ending in April. So it's April and March timeframe. That 0.3% came in at expectations, but higher than where we were back in that February to March change of negative 0.1%, excuse me, that rate. So very slow, but we're continuing to see this pick up, and hopefully when we see the May numbers come out, we'll continue to see these positive growth numbers. So the inventories number looking positive. When we look at housing, we can see permits up 1.3 million. Overall, this is a month-over-month change, was down by 4.6%, but year over year, we're up 8%. So very strong year-over-year numbers in permits. And then as we look at starts was up 5%, ending at 1.35 million homes being started. And then the overall new home sales at 689,000, that's up 6.7%, very strong. Year over year up 14.1%. So continue to see that strength in the new home sales. And that's positive when we look at the overall economic environment. When you buy a new home, you need to furnish those new homes, and typically we put new furniture in there, and therefore we're starting to see that flow through, and that should help the retail sales as we move along. When we're looking at existing home sales, you can see we're up to 5.43 million existing home sales. Overall, month over month and year over year, we're down. So a little bit of pull off in this new home sales, but you can see the overall median price is up to $264,000. That's up 4.9% year over year. Because of the tight supply of just 4.1 months, we continue to see the overall increases in these medium sale prices. So that tends to slow things down, as well as the higher interest rates compared to last year on the mortgages start to pull off the overall level of home sales. But we should continue to see this home environment, this housing environment, be positive in here and for the economy. Flipping over to the rates, the 10-year 2-year spread. This solid line is the 10-year rate. You can see we're up over that 3%. We knocked back down, and we're at about a 287 today. When we look at today would be the 25th, the end of the 25th. When we look at the 2-year Treasury, we can see we continue to move up to the 252. So that spread is getting very tight, and we can see the spread line down here coming down. We're down now to 34 basis points, continuing to get tighter and tighter, almost getting into that inversion environment here, but we still have 34 basis points to go. Continue to say that 10-year Treasury, because of the risk sell-off, we're going to continue to see that under that 3%. By the end of the year, I would even say we're going to continue to be between that 285 and 295 range. Looking at the CD market, these average rates taking from the bankrate.com off of Bloomberg, and you can see over the past 3 years we continue to see an increase in rates, particularly on the long end, where we see a 50 basis point change between 2016 and 2018, going from a 123 up to a 173. Now, these are not those special rates out there. These are just the average rates. So we continue to see the increase in the CD rates. In terms of the money market, over the past couple of weeks, we started to see this increase. And in fact, when we look at it on a chart, you can see this happening. We're now up to about 52 basis points on the average, the national average money market rate. So continuing to pick up, and considering that was around that 30 basis points, up 20 basis points only over the last couple of months. And that's a significant increase in that average. So continuing throughout the end of the year, and we've been saying this, these core deposit rates are going to continue to have pressure to increase as that Fed fund rates continues to increase and those short-term treasuries continue to increase. So this is where we are today with those deposit rates overall showing the upward momentum and pressure now starting to build more and more on these core deposits. That's what we have for you today. We look forward to seeing you back here in our next briefing. Have a great day, everyone.